Hey guys, Toni Taylor over at Interconnect. We were having a conversation around the water cooler, if you will, from different locations, but we were talking about what we're seeing from questions from customers as well as real estate agents and, kind of the things that we bring to the table from an experience standpoint. All of us have a lot of longevity in this business. We've seen a lot in our 30, 20 years in this industry. So one of the things that we're hearing people say and ask us is, what do you think is going to happen? Do you think there's going to be a correction on the market values? And Mark, you had some really good points that you were bringing up. So you want to share with everybody what your perspective is here?
Yeah, and this is based on just going through this once before with the housing correction and the bubble bursting in the early 2000s. There were several reasons why the market got so hot back then. One was the fact that guidelines were so loose, almost anybody could borrow money. I mean, there was a term that was thrown around often. You heard liar loans. If somebody could breathe, they could borrow. So we all heard those expressions. That's not the case this time. These are very qualified buyers. If you are borrowing or you're an agent working with buyers, you know that the programs and the underwriting guidelines now are much more stringent. So we're dealing with a much higher quality, if you will, of borrower. And then secondly, there was a ridiculous amount of artificial demand in the market during that time. And by that, I mean, we saw borrowers and just regular people, not savvy investors, but W-2 wage earners, often with 6, 8 properties on their portfolio. So you had one person taking down multiple properties. So the buyer pool was lower, but the demand was higher. That was artificial because if the market goes south, that person's going to dump those 7 or 8 investment properties and fight to hold on to their primary. Those homes enter the marketplace and push prices down when they get foreclosed on. So that being considered, we're not seeing the same risks associated with the market that we did during the correction of the early 2000s. And that's not to say there may be easing in pricing, but the affordability of a house with interest rates. I'll let somebody else talk about that. We were just covering that too. There's some protection built into the market just because of the cost of money at the current state of things at this point. So I'll let somebody jump in and cover that, but I just think those are points that we need to consider when we're talking with our clients or our friends about what the next cycle is going to look like in housing.
I agree with what you're saying in regards to the quality of the buyer, because I remember back in 2007 and that era, or that year, those couple years that were following, and the
ones that we all have a little PSTD from.
Yes, exactly. I remember the type of buyers that I had. I remember the type of buyers, and definitely the guidelines were so loose. I was able to do the loans that probably shouldn't have been done because the guidelines were so loose. I'm glad that the guidelines right now are as strict as they are, and that the quality of buyer is it's just there. It's just there, and the stability of it is there. So even during this COVID time, I'm surprised at the stability of of the market right now. Yeah, for sure. Is the market going to go down? Who's to say? But, but even if it does, I think that the type of loans that are given out right now with the low rate and everything, even if it does fluctuate a little bit at the end over time, I think it's just gonna, it's just going to even itself out.
Yeah, and I think I agree with you guys, and there's just some kind of points I would drill down on is that, what Mark was kind of alluding to is right now, let's just say there is an adjustment in the values of homes. If the rates go up and you're buying a less expensive home, you still have the same mortgage payment. So right. It doesn't matter. It's lateral, right? And the one thing that we know over time is that it is almost impossible to outsave appreciation. So if you want to be in the home ownership game, there has never been a better time. Mark has some documentation that shows how quickly you make these things up. It's just, there's no way to outperform or outsave that equity that you're going to get, as well as just even outside the outsave the appreciation, even get down payment money together. So if it's something that you've been thinking of doing, I think that it's an amazing time. So I would definitely not tell you to hit the button. And as Deanna was saying, guidelines are just not what they were a decade ago, 13 years ago. At this point, it's hard to believe it's been that many years ago, but they're just not. They're more restrictive, and it's so the people that are getting into homes are more highly scrutinized, and the demands and the requirements for them to qualify are greater. That compounded by the appreciation that has occurred, people have equity in their homes. So, are there going to be some people that have faced some hardship because of the pandemic? Yeah, obviously there's been families that have suffered from this, and that stinks. The good news is that many of those people have equity in their homes. And so that's going to change how this is going to look on the landscape going forward. Now, I don't have a crystal ball. None of us do, right? So we take our history, we take our experience, we see where the markets and the climate is, and we know, we're talking to you guys from South Florida. I feel like on some levels we get a little bit of a buffer because we always have this influx of people from the north, and that does change things. But I think that the bottom line is if 2021 you want to be a homeowner, reach out. Let's find out what we got to do to make that happen for you, so you don't have to sit on the sidelines. You can start building that equity and take advantage of these historically low interest rates. We locked a loan. We have a loan in process right now. It's a VA loan that's got a 2.25% interest rate on it. So everybody, the rates are different depending on your credit score, your occupancy, the size of the transaction, the location, many different variables. It's not a one size fits all, but it's definitely could not be a better time if you want to own a home to get in the game. And if you do want to own that investment property, you can get in there, and like Mark was saying, your debt service is going to carry way better because the rates are so low. So it's an amazing time. If you need us and we can help, let us know. 561-440-2010 is our lead hotline, and we're always here to help.